Now, the European Central Bank is running on a low interest basis, which means that the European Central Bank keeps the interest rate at 0%. Essentially, the interest rates are essentially the loans are free, and this low credit basis is driving is driving the PMI that you can see on your right of the screen. The European Union and the EU 28 as such have been performing well even in some of the other metrics as well. So if you look at the unemployment rate, the unemployment rate of the European Union is 9.3%. The Eurozone area, which is the core European Union, is a 7.8%. Both of these unemployment rates are the lowest since March 2009, before the financial crisis hit Greece. But as always, in a very large economic bloc, growth will not be uniform. If you look at the unemployment numbers, once again, we'll notice that countries like the Czech Republic, Germany, and Malta will have very low unemployment rates, closer to about the 4% mark, whereas Greece continues to have over 20% unemployment, and Spain has about 18.6% unemployment rates. Because of the uneven growth, the European Central Bank is still reluctant to raise the interest rates despite the strong economic activity data. Last year, about 1 year ago, the United Kingdom held a referendum to decide whether they must stay with the European Union or they must exit the European Union. And there was a slight majority which favored an exit of the European Union, which triggered the Brexit. Last month, Britain triggered Article 50 of the European Charter, which is basically the move that the United Kingdom will be taking to exit the European Union. British Parliament, the British government currently is the Conservative government, which is also backed by the UK Independence Party. Currently, they do not have a majority in the House of Lords, which is the equivalent of the Rajya Sabha. Owing to this, the Prime Minister, Theresa May, had called for flash elections. Because the United Kingdom is looking to exit the European Union, and it looks to have a hard exit of the European Union, which is basically cutting out all ties, cutting off all migration and free trade with the European Union. It is looking, Prime Minister Theresa May is looking for strong support from the Parliament itself. Owing to this, a flash election was called, and the election results were declared on 8th June. And the results did not favor Theresa May. The Parliament continues to be hung. And so this also brings in a bit more policy uncertainty to Britain itself, alongside the fact that it will have a moderate or a soft exit from the European Union. Now, if you look at why this matters, because the British elections, as you can see in the graphs over here, as soon as the election results were declared, you can see the value of the Great Britain pound declined across all currencies across the world. To your left, you can see how the British pound fell from 83.5 rupees to 82 rupees. Similarly, the British pound to the euro had also fallen in value, as did the Great Britain pound to the US dollar. Now, if Britain did manage to get a hard exit, there would have been a chance that this rally, this currency downfall would have been averted. But now, because of the elections, there is a hung parliament, which means there's policy uncertainty. Now, Brexit as such was expected to give economic problems to Britain. Now, this will, with the hung parliament, the economic situation in Britain could worsen. Looking at the other developed economies, looking at Japan. Japan, which has been battling chronic deflation since the 1990s, had a positive inflation for the 4th consecutive month. This could definitely be a shot in the arm for the Bank of Japan, which is currently maintaining negative interest rates, one of the very few economies in the world to do it. Other metrics of the Japanese economy indicate positivity. We can see that the composite PMI, the manufacturing and services activity, all of them are in the green. They're expanding at a robust rate. Unemployment rate is at a multi-year low, the lowest since the 1990s. And the wage growth has also been positive. However, with the British elections, what happened was there was a higher demand for safe haven. Traditionally, three instruments are safe havens. We would have the United States dollar, the Japanese yen, and gold. With the results of the British election, the Japanese yen strengthened, and Japan being an export-dependent economy, the exit of the election results of the United Kingdom is bad news for them. This would make Japan less competitive in an export in the export market. Next, we look at the United States. The United States economical activity has been quite positive. The service activity, the manufacturing activity, and the composite activity, all of which have been in positive. Last month, however, the job addition was a bit low. About 138,000 jobs were added in May, but this is about 66,000 lesser jobs added compared to April. But that said, the unemployment rate of the United States is still much lower than what it was before the Great Recession. So economic numbers indicate that the United States economic activity is picking up. The wage growth also is at 2.5%. All of these will indicate that the Federal Reserve will be looking to raise interest rates in the coming few monetary policy reviews, and this was also reflected in the last Federal Reserve meeting. Moving on to Asia Pacific and the emerging economies as such. The biggest emerging economy in the world, China. The second largest economy in the world, China. So anything that happens to China has a ripple effect on all the emerging economies across the world. Most recently, China had a ratings downgrade that happened in the earlier over the last 1 month. Now, if you look at the economic activity of China, China traditionally has been a manufacturing-driven economy, and the manufacturing activity in China contracted in May 2017. Whereas other indicators of the Chinese economy, such as the services and the composite activity, they were positive. But manufacturing is the biggest part of the Chinese economy, so there is still a bit of a concern that the Chinese slowdown may be much faster than expected. After the Great Recession of 2008, China had borrowed heavily and had a credit-fueled growth. This led to most recently the the debt to GDP ratio of China is almost 260%. Now, this very high debt proportion led ratings agencies across the world, such as Moody's and Fitch, to downgrade China. This is the first time the sovereign rating of China has been downgraded in almost 30 years. With that said, China's credit rating is now an A1, which is the same as Japan's. So while it is still in investment grade, it is still a downgrade nonetheless, and this will have an effect on the emerging economies across the world. The biggest dependents on the Chinese economy are the ASEAN economies, which is the Southeast Asian economies. Now, with the slowdown in manufacturing in China, you can also see that the manufacturing activity in the ASEAN economies also has gone down. The manufacturing PMI of China was 50.3, which indicated a moderate to almost no expansion. whereas in May 2017 it read 49.6, which means it is a decline in manufacturing activity. Similarly, can also be seen in the ASEAN economies. ASEAN manufacturing PMI was at 51.1 in April, which indicated a moderate expansion in economic activity in manufacturing, whereas in May 2017 it fell to 50.5, which indicates flat to moderate growth in manufacturing activity. In the next month, we can expect the manufacturing activity of the ASEAN economies to drop. Looking at the Latin American economies, the biggest economy in Latin America is Brazil. And for the first time in almost 8 quarters, Brazil's GDP expanded, but by 1%. This essentially indicates that Brazil is out of the worst recession it has experienced, which is over about 2 years. Brazil's economy is expected to expand by about 0.3% this year. Now, with Brazil expanding, the other Latin American economies, which have very large exposure to Brazil, will also be expected to expand. If you look at the PMI numbers of Brazil, in April, the manufacturing, the services, and the overall composite PMI were all in positive, having a reading of over 50. But in May, we saw the manufacturing activity of Brazil expanded much faster rate at 52.0, whereas the services activity of Brazil declined with a PMI rating of about 49.2. But overall, the composite PMI of Brazil is still positive at 50.4, meaning there is the Brazil economy is still reviving. Brazil's GDP is expected to grow by about 0.3% this year. The most stable and the developed economy in the Latin American Association is Chile. Chile's Q1 economic expansion was the weakest since 2009. The main reason for this being Chile is a country that depends on copper for exports. Now, with strikes across copper mines in Chile, economic activity in Chile is expected to go down. Why this matters is because Chile is the largest exporter of copper in the world. When there's a slowdown, when there's a strike in Chile, this means that you will have a shortage of copper supply, which also means the price of copper is expected to go up. And if price of copper goes up, a lot of electronics, a lot of electrical gadgets, prices will also go up in terms of raw material costs. Now, earlier I had discussed how anything that happens to China will affect all the emerging economies. The biggest example of this can be seen in the form of the exchange rates of the currencies. This is the US dollar versus Chinese yuan exchange rates. Right after the downgrade towards the end of May, the Chinese yuan, which was traditionally about between 6.88 to 6.9 yuan to the dollar, dropped drastically. The Chinese yuan weakened. Now, this indicates that the other emerging, this would indicate that similar to how we had seen in the previous graph with respect to the United Kingdom, this should have indicated that the Chinese yuan should have weakened against the whole basket of currencies. However, if you look at the Indian rupee versus the Chinese yuan currency, you can see that the Chinese yuan is strengthening. Earlier, when 9.3 rupees was equal to 1 yuan, now 9.45 rupee has become 1 yuan. Why did this happen? Essentially, China is the biggest emerging economy in the world. If anything, if any economic event happens in China, if it's a boost or if it is a shock to China, will affect rest of the emerging economies. Consequently, you can also see that the Indian rupees versus US dollar had also weakened. Now, moving on to commodities. The crude oil price, crude oil is one of the biggest imports of India, and Qatar versus the Gulf, Qatar, which was part of the Gulf Cooperative Council and also one of the members of OPEC, currently has political tensions with the rest of the members of the Gulf Cooperative Council. Qatar is the world's largest exporter of liquefied natural gas, and it is the 17th largest exporter of oil in the world. Now, with the Gulf Cooperative Councils and the Qatar cutoff due to political reasons, oil prices did rally briefly. But then they came back to a range of hovering about $48 per barrel. Primary reason being Qatar and the Gulf Cooperative Councils are all members of OPEC. And OPEC has, in the recent times, looked to cut down production, thereby increasing the price of oil per barrel. Saudi Arabia, which is the world's largest exporter of oil, would like to have oil at about $60 or $65 per barrel to support its to support both its oil dependency and at the same time diversify its economy away from oil. However, with the political standoff, Saudi Arabia stands to lose out on an opportunity to raise the oil prices. The supply of oil continues to exceed their demand for oil. So oil prices will continue to stay at about 48, less than the $50 per barrel mark for a while. That said, if the political standoff between Gulf Cooperative Council and Qatar escalates, there is also a potential chance of oil supplies declining without the intervention of OPEC. So there is a bit of a risk in terms of oil prices going up. Looking at gold, which is the other biggest import that India has in terms of commodities, gold has been reacting primarily to political events across the world. So between mid-April and early May, gold prices had declined, primarily because of the French elections. France had elected Emmanuel Macron, centrist, who was also a pro-European Union leader. His opponent at that time was Marine Le Pen. Marine Le Pen had proposed to exit the European Union. If France exited the European Union, they would be the second biggest economy to exit the European Union, thereby destabilizing the whole region. Now, with Emmanuel Macron, the European Union is much stronger. And this can also be seen in the exchange rates of the euro versus the British pound. What this also meant was, because the European Union was, with the election of Emmanuel Macron, the investors no longer did not look for a safe haven. They were much more sure of taking a bit more risky investments, which means that dependency on gold as an investment went down during that period. However, mid-May onwards, oil prices rallied up again. And this had a lot, once again, to do with the political reasons. Among the reasons included a rather volatile political situation in the United States due to statements and actions taken by the White House. So we had a standoff between the FBI and the White House, which also led to calls for calls for an impeachment of the president. All of these indicated that the US presidency may not really be well settled at the moment. So there is a bit of political uncertainty in the United States. Now, any event of uncertainty automatically triggers a crash in the markets. At the same time, it will also uh, 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 seek greater investment in gold, because gold is an instrument that thrives during times of volatility. Similarly, gold also had rallied post the declaration of the results of the British elections. Because there's a hung parliament now, there is much more uncertainty in terms of policies emerging from the United Kingdom. Looking at all of this, we now come to India. Economic activity had slowed down a bit during April. Services activity had was almost flat at 50.2, but economic activity picked up in May. We had composite PMI increasing to 52.5, manufacturing 51.6, services at 52.2. With an expansion of activity in manufacturing and services, what this also means is there is an opportunity, there is an increased opportunity for job creation in these sectors. RBI had a policy review over the past week where they had stated, where they had maintained status quo. They would not be changing the repo rates or the reverse repo rates. However, they did alter the statutory liquidation rate, which is for the banks. Now, the estimated inflation rates, the CPI for May 2017 is expected to be 2.63%, and inflation as measured by the wholesale price index is at 3.11%. Now, these are comfortably below the 4% mark that the RBI would like the inflation rate to be. In its last statement, in its last monetary policy committee meeting, the RBI had expected that towards the first half of the financial year, inflation rates would be between 2.5 to 3%, and going forward it'd be between 3 to 3.5%, which all of are comfortably within the 4% mark. What this indicates is the RBI can be expected to lower the interest rates in the coming in the next monetary policy meeting. Now, this bodes well for the Indian economy itself, as such, because the Indian economy, because the RBI maintains one of the highest interest rates in major economies across the world. The effects of demonetization, which happened in the third quarter, were not reflected in the GDP numbers of the third quarter. However, they were reflected in the fourth quarter. The Q4 GDP expanded by only 6.1%, and this was primarily attributed to demonetization. Overall, the Indian economy grew by 7.1% in the financial year of 2016 to 17. This is less than the 7.6% which they had experienced, which the economy had seen in financial year 2015 to 16. The World Bank expects the GDP to grow by 7.3% this year. The RBI, with the policy rates being left unchanged, has indicated that it might be that there's a chance of it lowering interest rates in the coming quarters. But it also cautioned of inflationary pressures coming primarily due to global economic factors which we had discussed previously, which includes a potential of the oil prices rising, and because of China's downgrade, emerging economies itself having taking a hit on their currencies, among others. One more reform coming in India's way. After the end of this month, India will be unified under a service, will have uniform tax code, which is the GST. We have covered the GST in some of the previous webinars, so we will not be dwelling too much on the topic at in this particular session. Essentially, because of the GST, we can expect the economic activity to pick up. Many economists have projected that the implementation of GST itself can add about 100 basis points to the India's GDP growth. The RBI, in its last policy review, also observed that the rates are fixed such that the inflation will hardly be affected because of the GST. All of these indicates that there is quite a lot of positivity for the Indian economic story. Now, what does all of this mean to you as an individual? Now, the China slowdown and the Qatar's and the Gulf Cooperative Council's rift, this may reduce oil prices in the near term, but in the future, you can expect more volatility in the oil prices. The British elections, as we had discussed under the commodities, has increased the price of gold. So the price of gold, so now would not be the now the price of gold jewelry will be much higher than what it would have been about 2 weeks ago. Now, with China's downgrade, imported items will be slightly expensive in the near term. But over time, we expect that the Indian economy to be performing well to retain a balanced exchange rate. Thereby, the imported items will become much more at par. Looking at the Indian economic's activities, the RBI statement indicates possible rate cuts in the near term. What this means is loans are likely to get cheaper. Now, with the introduction of GST, however, eating out will become a bit more expensive. So you might have to monitor your budget with regards to eating out. Now, after all of this, we arrive at our investment strategy. Equity markets have rallied to all-time highs. Now, with the rollout of GST, equity markets will be expected to rally further for the longer term. Now, it would be much more sensible to write the benefits of the GST over the longer term rather than shorting it. So, it would be best to invest in equity for the longer term as well. Now, with the RBI statement indicating a chance that it will be reducing interest rates, we can expect loans to become cheaper in a few quarters. But that also means that government bonds for the longer term will also become attractive. In a previous webinar, we discussed how when the monetary policy had been changed from accommodative to neutral, longer duration bonds had become less attractive. But with the RBI statements, it would indicate that bonds of longer duration are now back in vogue. So investing in bonds for the medium to long term will be beneficial for you and your portfolio. One, you get the benefits of the bond returns in itself. Second, you will also have stability in the portfolio in terms of growth, where the equity markets induce volatility. Additionally, we have gold as a hedge against volatility in the global against volatility emerging from global events. Gold should be about 5 to 10% of the portfolio, but it should only be used as a hedge, not as an instrument for returns. In the coming months, we do expect a bit more of uncertainty coming, because of calls of the impeachment in the United States of the president and policy uncertainty emerging from the British elections. All of these will also be reflected in the stock markets. So gold will be good to have in the portfolio as a hedge. With this, we reach the end of our webinar. Thank you all so much for your participation. We are now open to questions.